Welcome to both of you. Courtney, I'm reminded, so Nancy Tangler had a piece this week, and it's interesting to see this is where investors' minds are going, where they say, you know what, and this was some Fundstrat data as well, maybe the Volcker years weren't that bad for the stock market. You know, as Rick says, the inversion is that the worst since 1981. Actually, equities did okay after Volcker threw us into a double-dip recession. I would just appreciate your response to what you think is playing out here post-Powell.
Yeah, and I think what's interesting to see is we do continue to have an inverted yield curve. And even today, we saw the 2-year Treasury moved a lot more than the 10-year Treasury. What that means is markets are really pricing in that longer-term inflation is still coming down. The big question is how soon it's coming down and how quickly are they going to raise interest rates and for how long. But really, this is going to be more of a short-term problem. Markets still see this as longer term. And the other thing you want to look at, because again, it's the bond markets that you really want to look at when it comes to inflation, the credit spread. So when you look at the yield that a corporate bond is paying versus a treasury bond, normally investors demand a higher yield for what they consider a riskier asset. Right now, there's not a huge difference between a corporate yield and a treasury, meaning they don't deem a recession a huge risk right now. So we see inflation still coming down over the long run. Not a recession is not necessarily being priced in. And that hasn't necessarily changed today. But I think the bigger thing is going to be the data points that come out on Friday. We get the jobs report. We get the CPI report coming out next week. I think ultimately the Fed is going to be data dependent. We need to see what happens with those before we know where they're going to go going forward.
Sure. Michael Cuggino, what jumped out to you? And what do you make of the action today in response to Powell's comments?
Honestly, I don't think there was anything new here. In our view, the terminal rate was always going to be between 5 and 6%. I don't think that really changed despite the hawkish talk. And I don't see a real strong risk of it. Soft landing, shallow recession, there's not much difference between those. But the real risk would be a deep and long recession. And with the employment picture so strong, I just don't see that happening. Now, granted, that could be a lagging indicator. And if employment falls quickly, all bets are off the table. But until you have that happen, people are working, they're spending, it's propping up the economy. It's allowing companies to push through some pricing power. It's allowing businesses to plan. It allows inventory to keep growing and being sold. So, the question is, at what rate does the economy not grow with respect to interest rates? And we don't really know that yet. Going back to the Volcker comment, we saw in the 1980s that we had still generally high interest rates because they were coming down from the real high levels of the early 80s.
Right.
And we still had a good decade of economic growth. So the U.S. economy in the past has demonstrated that it can grow with higher rates for longer. But will that be true this time around? Because we're obviously not talking the 1980s. And so that is a question.
Yeah.
And I think inflation, we expected it to come down a little bit and then stabilize, given the offsets of interest rates working their way, their interest rate volatility working their way through the economy, the big year last year. But that would be offset by stimulus from the Inflation Reduction Act and the budget bill that maybe also hasn't worked its way through the economy yet. So there's a push-pull scenario there on how quickly inflation could fall further from that, say, 4 to 6% range.